So our next panel is discussion on the impact to the Indian economy. For this, I'd like to invite our moderator who's going to join us virtually, Mr. V. Thiagarajan. Mr. V. Thiagarajan is currently the chairman of the SYFX Treasury Foundation. He's well known in the forex markets with nearly 25 years of trading experience. He teaches both fundamentals and technical analysis in all the professional training programs in the country and abroad. In 2003, he moved to Reliance Industries Limited as Senior Vice President Forex and rose up to being in charge of Forex Treasury. Next, I'd like to invite Dr. Rajeswari Sengupta. She's an Associate Professor of Economics at Indira Gandhi Institute of Development Research, IGIDR, in Mumbai, India. She has also held research positions at the Institute for Financial Management and Research in Chennai, the Reserve Bank of India, and the International Monetary Fund, IMF, and the World Bank in Washington, D.C. Her research focuses on policy-relevant macro-financial issues of emerging market economies in general and in India particular. She has published in reputed international journals and has also written chapters in various books published by Asian Development Bank, G20, the Center for International Governance, Innovation, CIGI, among others. Can we please have Dr. Rajeswari Sengupta on stage, please? I think she'll join after some time. Next, I'd like to invite Mr. Saugata Bhattacharya. He's Executive Vice President and Chief Economist at Axis Bank. He's a member of the CII National Councils on International and Trade Policy and on Financial Reporting, the CII Western Region CEO Economist Forum, and ASSOCHAM National Council on Banking. He has been a part of RBI Ministry of Finance and Ministry of Housing and Urban Affairs committees earlier. He's a member of the Executive Council of the PGDM programs of the National Institute of Bank Management, NIBM, Pune, and the Academic Council of NMIMS, Mumbai. Can we please have a round of applause for Mr. Saugata Bhattacharya? Next, I'd like to call upon Mr. Rahul Bajoria. Mr. Rahul is the Managing Director and Chief Economist for India and the Antipodes, Barclays. Mr. Rahul also leads the economics teams covering M-Asia ex-China and is responsible for driving thematic research across Asia-Pacific. Mr. Rahul has also worked at INSEAD Singapore and NUS Business School, looking at issues around productivity and growth. He joined Barclays as a part of the graduate class of 2009 in Singapore, covering economics across the Asia-Pacific region. Can we have a huge round of applause for Mr. Rahul? Next, I'd like to call on stage Dr. Ajit Ranade. He's the Vice Chancellor of Gokhale Institute of Politics and Economics in Pune. He was earlier Group Executive President and Chief Economist with the Aditya Birla Group. Mr. Ranade is a member of the Executive Committees of Apex Industry Chamber CII, FICCI, and NCCIA. He has also been a member of the board of several companies and trusts. He writes in the business press on economics and current topics. A huge round of applause for Dr. Ajit Ranade. Over to you, sir. Mr. Thiagarajan.
Thank you very much. Good evening, ladies and gentlemen. Thanks, Almus, for the opportunity to moderate this flagship panel discussion of the conference. Instead of being on the on-field umpire, I am participating as a third umpire. Extremely sorry for that, but of course, this is circumstances. We have had a high-quality presentation since morning, and the panel possibly brings home we can very well say that financial economy was reflecting the real economy. And the paradigm shift happened in global financial crisis. And from then on, actually, financial economy is not really reflective of what is happening in the real economy. I think this dichotomy has been going on for nearly 14 years. Whether this dichotomy is going to end probably in 2023, not sure. The, the question actually boils down to whether you are going to chase the bubble or choose to accept the macro reality. I think this is going to be the question of 2023. And a set of central bankers who paid a war cry not too long ago that we will do whatever it takes. Now we have got a set of central bankers who are shouting every day, I will break whatever it takes. So whatever it takes to break, we will do. That's a kind of the shift that has happened in the central bank thinking. So the macro perspective is going to be the primary importance. Actually, if you ask any trader in the last 14 years, actually, no macro trader would have ever played one, honestly speaking. But it is very difficult. They will not fighting the markets. Now, from here on, possibly the macroeconomics is going to engage the attention of the markets. The economics which has lost relevance in the last 15 years, I think it is making a big comeback. The composition of the panel itself is a sign of what things are going to happen. Normally, we would have had a practitioner sitting alongside this economist talking about the practicalities of applying economics in the market. But right now, we have got all four eminent economists. It's my privilege to be a moderator of this panel discussion. Let me start with a question to Dr. Ranade about the global growth. Of course, everybody is talking about the recession. Of course, in 2023, it's going to be a recession. The basic question is how deep it is going to be, or whether it is going to be a shallow recession. Dr. Ajit Ranade.
Thank you, Mr. Bhattacharya, and good evening to all of you. So, how deep is the recession going to be? I don't know, but I think there will be a recession. These kind of sharp changes, we saw on 20th April 2020. On 20th April 2020, more than 2 years ago, the price of oil was minus $37, minus, negative. And that was, of course, if you remember, I think Rahul will remember, the West Texas Intermediate, WTI crude, and this is technically a forward price, not the spot price. But basically it was minus 37 and then it went up to 120, 140. So these kind of sharp movements happen in oil markets, maybe in some commodity markets. But sharp recessions are, I don't think, going to happen in the world. You'll see when global GDP growth rate slows down from 3.7 to 3.1, we call it sharp. Oh my God, it's sharply down. Then when India's GDP forecast is revised downwards from 6.7 to 6.3, oh my God, sharply down. So if you mean sharp in that sense, yes, there will be a sharp, but otherwise I don't think there is enough degree of diversity in the global economy, because countries like India will continue to grow at around 6% or higher. There are countries like economies like the US, which I don't think will be in negative territory. And there'll be Germany and possibly some of the large European economies which will actually have a GDP contraction, but even the contraction will be a minus 0.5. I just want to spend a minute on this just to give you the perspective. When the US economy grows at 0%, when the US economy, if and when it does at 0%, it means it produces about 17 million new cars, right, Shrikant? 20 million. So 0% growth for USA means 20 million new cars. And 8 million new cars for India means 10% GDP growth rate. So if the US technically grows at minus 0.5%, instead of producing 20 million new cars, they'll produce 17 or 18 million new cars. Okay, we are not. So one has to be careful when we say recession, negative, positive growth. So my short point is that because of the variety of economies today, China possibly slowing down to 2 or 3%, India at 6%, Germany at minus 0.5, minus 1, America, I don't know, maybe 1%. So overall, you will have a global GDP growth during calendar 2023 at, I don't know, 3% or 2%. And if you want to call that a sharp recession, it is, but I think that's the way it's going to be. So basically, the next few years, we're going to just have growth rates of that kind. We're not going to go back to global GDP growth of 5% or 6%, nor will we be close to zero. Thank you.
And that's reassuring. Rahul, coming back to you, in the context of weakening global growth, what is your take on regional economics? For that matter, what do you think of China actually? What is transpiring there? And whether China is going to be inward looking? That's a basic key risk for 2023.
Thank you, Thiagarajan sir. I think, in the context and the picture that Dr. Ranade has painted about effectively sort of reverting back to mean, on global growth in terms of what we have seen, but the disparity across various regions probably is going to increase, where you have, Europe sort of going through a shallow but a fairly persistent recessionary outlook, largely because of commodity price shocks. We have global manufacturing sector basically going through what already feels like a recessionary outlook, but services holding up reasonably well, both in the US and also in large parts of emerging economies. And this is effectively a function of what we see as a post-pandemic recovery, right? I mean, high contact services coming back in a big way. In this particular context, I think China obviously was the big outlier in 2022, right? Because as the world was reopening, China actually went into what was probably the most stringent of its 3-year lockdown that they've experienced, where zero COVID effectively broke down. But then after what was a fairly stunning images coming about protests in large cities, I mean, there has been a very distinct shift in the zero COVID strategy. Now, whether it works or not, because if one takes a long view of a 3-year period, I mean, zero COVID actually has been a very successful strategy, but it's not worked in the last 1 year primarily because of the transmissibility of the Omicron variant. And as they exit, I mean, whether China sort of goes through a round of persistent or disruptive lockdowns again to manage the virus, how smoothly they are able to get out of it without having to revaccinate their entire population also remains a bit of an open question. So these are the known unknowns. But then what is very clear when we sort of take a step back and think about going into 2023, China's consumer outlook has definitely improved at the margin, right? Because the steps that have been laid out just in the last few days, there was this 10-point easing measures that was announced by the NHC, which is their health council, which clearly shows that on a 6-month horizon, Chinese consumption, Chinese spending should actually be increasing, not decreasing as a result of the domestic measures, and that should provide a degree of comfort to the region at large. India, is for all valid reasons, I think, kind of stands out as an outlier, even though we expect there to be a bit of a slowdown. I think what is very visibly clear is that the lack of leverage or the reduction in leverage in the last 3-4 years, the hard yards that were done even before the pandemic set in are acting as a tailwind for us. So the regional outlook is one where the manufacturing sector, which is a very large part of Asia's economy, is going to be in a bit of a doldrum as Western demand comes off. But then the invisibles, the non-tradable sector actually looks to be doing okay. And we reckon that probably will sort of anchor the growth outlook in the region, but not necessarily prevent the cyclical slowdown from playing out going into 2023.
Just extending that to further, Mr. Bhattacharya, what do you think of Indian view? How it is evolving?
So, thank you, Mr. Thiagarajan. Good to see you after a long time. Thank you, Almus, for this opportunity of coming in here and interacting with all of you. So, point number one is that India's economy seems surprisingly, almost incredibly resilient to these major shocks that we have been exposed to, series of shocks, one after the other. Now, particularly with very sharp rate increases and which has been transmitted very, very quickly. I mean, this time because of the link to the repo rate, the external benchmark rate, a large segment of the loans, the rates have been transmitted almost instantly. Given all this, all the indicators that we have seen remain very, very resilient. So that's number one. Second is from what we have heard on the global economy. I mean, there are three major channels of the spillovers from the global shocks or the global activity into India. Two, we are more or less already over. The first, the financial channels. We have had a large series of shocks on the financial sector, portfolio flows, other flows, foreign capital, etc., current account deficit. So that part is hopefully, fingers crossed, more or less over. The second channel is the commodities channel, and the commodities channel will now probably, again, fingers crossed, we don't know how things are going to pan out, China, US, we don't know what the geopolitical situation is likely to be, but hopefully even the commodities shocks that we have experienced, energy, metals, food, whatever you name, even that probably is a bit behind us. The third one now is is probably the one that will be the most dominant, and that's going to be the part of the reason that India is likely to slow down, which is trade. We are already seeing that in the context of merchandise trade. Services trade, particularly IT and even other services, non-IT services, still remains fairly robust, but I think it's only a matter of time, given the carnage that we are seeing in the tech sector in the US begins to transmit itself to India. It's not going to be a huge impact on IT services because IT, I mean, the discretionary and the non-discretionary spends. Discretionaries will probably be postponed a little bit, but the non-discretionary is going to remain robust, particularly now with the increasing automation, use of IT systems, etc. The third point in all of this is that now we expect India to slow. I'm quite sure. I mean, whether we grow at 6.5%, 7% this year, growth will probably slow to about 6, 5.5, 6, 6.5, who knows, next year, FY24. But we should slow down. In a situation where the global economy slows and we carry on at 7%, will increase the imbalances, the macro imbalances, particularly the current account deficit. And as a consequence, I mean, even the fiscal side. So we should slow down to minimize the possibilities of these macro imbalances coming up. And that's the broad picture that we see going forward in the next year or so. But hopefully we will remain in a very good spot, and that will have other macro consequences.
Thank you, Mr. Bhattacharya. Dr. Rajeswari, actually expanding on the point that Mr. Bhattacharya made, if global growth is declining to, let's say, 2.7%, and if you are going at, let's say, 6 to 6.5%, what are the parameters one should watch? We have never experienced such a kind of a divergence between global growth and Indian growth. Have you got me?
Yes, yes.
Hello?
Yeah, we can hear you.
Yeah. Basically, the divergence between India and global growth, to what extent actually one should watch which parameter, and probably the impact is going to be there on which parameter.
Thank you so much. And I just want to say at the outset that I'm truly delighted to be here in person. And I was telling Maulik today that the first time I participated in an Almus event was 2015. And it's really amazing to see that they have come such a long way from there. So congratulations to all of you. So before I exactly answer that question, I want to put a little bit of perspective on the India growth numbers. So there is a statistical illusion hidden in the 6.5%, 7% growth rate because there's a lot of contamination by base effect. Because we had 2 years of unprecedented events, a completely unprecedented shock when the GDP contracted. And then there was a recovery the next year. So none of which was a normal year. So ideally, we should be comparing the performance with the pre-pandemic year, which was a quote-unquote normal year, which is 2019. And when we compare with 2019, sort of skipping the statistical problem of the base effect, India has grown about 7.5% in the last 3 years, 2021 and 22, which roughly means that India has grown about 2.5% every year. During the same time, China has grown at about 12, 13%. Even a slow-growing economy like the US has grown at about 3.5%, 4%. So it depends upon how we are looking at it. It doesn't essentially convey the picture of a very spectacular performance per se. But yeah, compared to several other economies in terms of vulnerabilities and in terms of how we are responding to the global headwinds, things definitely look relatively better. Now, coming to the indicators, I think there are two very big near-term risks that should be worrying all of us. One is the current account deficit, and I don't think the problem is over yet. It could be anything between 3.5% to 4% of GDP or 3 to 4% of GDP this year. Now, ordinarily, having a high current account deficit is not a problem in and of itself if you're able to finance that current account deficit. The problem is twofold. On one hand, with the global growth slowing down, even in the worst case scenario with a shallow recession, let's say US slows down and Europe goes into a recession, it's still bad news for emerging markets like India because export demand is going to continue to slow down. Right? And given that India is still growing relatively higher than the other countries, the import demand will continue to increase. So the gap between the two, the trade deficit is going to be pretty high. On the other hand, the problem is to finance about 3.5% to 4% of current account deficit, you need at least 4% of GDP worth of capital inflows. Now, in a global environment where the buzzword today is uncertainty, we're living in unprecedented uncertainty today with a land war in Europe, the highest level of inflation in the developed world in the last 40 years, the fastest pace of monetary tightening in the history of the US Fed, China potentially slowing down. In this kind of an uncertain environment, typically, as we all understand, the foreign investors display massive amounts of risk aversion. And they are, as we have been seeing over the last several months, they go back to the safe assets of the US, they withdraw money from emerging markets like India. So in that kind of a scenario, financing 4% or even 3.5% or 3% of GDP worth of current account deficit is going to be a serious problem, which means that it's going to keep putting more and more pressure on the rupee to depreciate. And while, so as I said, uncertainty is the buzzword. So there is no guarantee as to where the US economy is headed, as Ajit mentioned. We don't know what the pace of growth slowdown is going to be, what is going to happen in the European economy as well with the energy crisis, etc. So given that uncertainty, there is this pressure on the exchange rate that is going to continue. And the financing of the current account deficit is going to be something that I guess we should worry about. The second parameter that I want to highlight here is the fiscal deficit of India. About a general fiscal deficit of more than 10% of GDP is one of the highest in the world right now. And that leads to a debt to GDP ratio of about 90%. For an emerging market like India, that's a very high level of debt. Now, once again, the only way forward for fiscal policy is fiscal consolidation. Right? The fiscal deficit has to be brought down over the next few years. Because again, financing this amount of fiscal deficit with the government borrowing large sums of money from the market is problematic. Today, interest expense is close to 1/5 of the total expenditure of the government, and that keeps increasing. And the more the government has to borrow from the market, that puts pressure on monetary policy as well, because if the RBI has to keep, and we have seen that during the past, if interest rates have to be kept low, then that also discourages capital inflows, and it conflicts with inflation management objective. So fiscal consolidation also means that it's going to be drag on growth. So now I want to end with the growth scenario, therefore. Even if, let's say, we assume India is growing by 6.5%, 7%, how do we sustain that growth going forward? The recovery from the pandemic was largely predicated upon a very strong recovery of export demand in the year 21-22. Now that is gone. Export is going to slow down from here on till there is more certainty about the global economic outlook. Private sector investment has continued to be sluggish over the last several years. Government expenditure cannot provide the necessary stimulus to growth because, as I mentioned, the fiscal deficit is exceptionally high. So then you take out investment and exports and government expenditure. Consumption by itself cannot give a 7 and 8% of growth rate that India needs, which is India's potential. And that is why I would be a little bit worried about India's growth going forward, given the two imbalances, the external imbalance in the form of current account deficit and the domestic imbalance in the form of high fiscal deficit. And I would end with that. Thank you.
Thank you. You dropped a lot of points in the table. I think that brings Rahul, actually, basically, let us talk about the most interesting aspect of financial markets nowadays, Fed pivot. Do you think Fed will pivot when the core inflation is running at 6.6%?
So at this particular point, I think, and this is a trick we saw the RBI also kind of pulling, is that, the words and the actions of global central banks may start to diverge at the margin, right? I mean, not that they are not going to be hiking further, right? So next week we have the Fed, we have the ECB, we have the BOE, RBI has just met, RBA had just met. And most central banks are actually starting to reduce the pace of hikes, mainly because, monetary policy works with long and variable lags. And so the impact on the flow economy is going to be felt a lot more as incrementally the rate hikes are going to come through. But then central banks are basically telling us, so this was a classic example last week when Governor Das in his press conference, despite the fact that we had a smaller quantum of rate hike, we had more, members of the MPC dissenting on various aspects of the decision. But then everyone came out of that meeting thinking, oh, the RBI is actually quite hawkish, right? And so it was a big push towards building credibility. And our sense is that the Fed, the ECB are also basically in the same boat, that even though they are going to be tapering down their pace of rate hikes, so we are expecting a 50 basis points next week. We reckon that maybe in February they go by another 50, but then 25. You could still see the Fed talking up risks to inflation, and that effectively is a function of kind of trying to talk down inflation expectations, right? I mean, it's something more to do with the fact that wage growth in US is kind of running close to 5.5%, and you don't want that to persist in the system, because unlike commodity prices, wages, particularly in developed economies which have large service sectors, tend to have a lot of muscle memory. And so you're trying to remove that muscle memory from the wage price setting behavior, and effectively that is why the pivot in terms of actions is already here, but in terms of words it might still take a bit longer for central banks to kind of signal that the risk or the monkey of inflation is off their back, right? And that I think might only be a phenomena when you actually start seeing activity levels break down much more strongly than what is currently visible in the data, which is not that strong, to be honest. I mean, we recently just upgraded our US near-term growth forecasts, even sentiment indicators as commodity prices and particularly gas prices are coming off is starting to improve at the margin. So there is a certain degree of resiliency in consumer behavior, which probably keeps global central banks, continue on the path of tightening at least for the next few months, at least indicate that they are not really switching gears.
So no pivot.
Not in a more subtle way, not in a full way.
Dr. Ranade, I heard an interview about where you were saying about the India should be careful about inflation next year. Can you please elaborate on that point? Now everybody thinks India has won the battle against inflation.
No, I mean, so long as we are at 7%, I still think that's inflation. So unless we have decided that 7% is not inflation, I think, the fact is that maybe because of our consumer basket, our CPI is biased in terms of food and fuel. To me, if it is anything above the target, 6%, it is still inflationary. It may not perhaps be double digit, difficult to say. I think if you look at inflation, for example, if you just take agriculture, the biggest contributor to agriculture is now meat and poultry and animal husbandry. And there is a huge amount of cost push inflation, the feed stock, something like 30-40%. And that's going to feed into, there's only so much control you can do on milk prices and egg and poultry. So that is one example of how inflation can creep into food products in agriculture. And the same is true for other prices. So I think we are not, and remember that the excise, just what Rajeswari said, even though oil prices seem to have come off, the excise taxes have not really been reduced, which means if excise taxation is going to remain high, that also is going to contribute to inflationary situation. So there's pressure from administered prices on energy, and then there's pressure on agriculture. So I feel I feel it's going to be very difficult, at least to my mind, to see an overall average for the whole year at less than 7%. And to me, 7% is inflationary.
So 7% inflation for let's say calendar year 23.
Yeah, I think it's going to be closer to 7 rather than 6.5. So that to me, that's something to watch out for. The fact that the Reserve Bank of India has already started taking action to me further confirms that they also are thinking about getting worried about inflation. At a time when all the factors that Rajeswari mentioned, that we are worried about growth, we are worried about export slowdown, we are worried about investment sluggishness, even then, per force, we are going ahead with rate hikes. So that obviously the inflation is coming back as a concern.
Thank you, Dr. Ranade. Dr. Rajeswari, then in that case, it's a firmer inflation and softer base.
So I would say that on inflation, I would in fact add two more points to what Ajit said. One is, of course, the food price inflation. Cereal prices have been quite high. The other point is also that core inflation has been remarkably persistent. It has been almost hovering at 6% for 3 years now. And such a persistent core inflation is deeply worrisome. And the Reserve Bank of India is also clearly worried about it. And we have to keep in mind that the legal mandate for the RBI is to bring inflation down to 4%. Somewhere down the line, I feel we have lost that perspective, and we somehow keep thinking that 6% is the upper threshold, and therefore if inflation comes down to 6%, it's fine. But there is a legal mandate that the RBI is bound by, which is 4%, and inflation is significantly above that target. And with the persistent core inflation of 6%, that means that inflation is entrenched. And therefore, how do you structurally bring inflation down to less than 6% is definitely proving to be a struggle. Of course, and the other point is that there is a very high risk of imported inflation, because the era of low global inflation as we knew it is over, just as the era of zero lower bound of interest rate is over. So in the US, even with a little bit of softening, inflation is around 6-7%. In UK, it is 11%. In the European Union, it's 10%. These are exceptionally high levels of inflation in the developed market. And so therefore, there's a considerable risk of India importing inflation as the rupee continues to depreciate. And we cannot ignore that. So I think inflationary pressures in India continue to persist. In terms of softer rates, I don't think we can, the real rate is still negative, even in the US it is. But at the same time, the RBI has been consistently hiking the interest rate and has turned hawkish, as Rahul mentioned. It's possible that after the next meeting, they may be pausing, they'll wait and watch for the data, because we also have to remember that monetary policy transmission works with a lag, even more in India than in the developed countries. It could be anything between 4 to 6 quarters of lag. And we'll perhaps only see the impact of this monetary policy tightening on inflation sometime next year. And at the same time, you also don't want to overshoot by over-tightening, because this is an extremely difficult forecasting act to do in such an uncertain global environment. So maybe the RBI will pause after the next meeting and wait and watch for the data and then take the next step. But I don't think that we are going to see softer rates anytime soon. We also have to keep in mind that, to put things in perspective, typically the interest rate differential between the US and the India over the last 10-20 years has been around 4%. US would keep the interest rate around 1%, India has been around 5% on average, right? Now, if the Fed pauses after 5%, that means RBI has to take it to 9%, and of course that's not going to happen. So it's an unprecedented scenario that we are witnessing, where the DM interest rate, the developed market interest rate, is at 4-5%. And even if the Fed pauses after March, even if they lowered it a little bit, they are not going to go back to 1%, 0%, or 2% of interest rate, which means it's a constant struggle for emerging market central banks to keep up, because we are also dealing with capital outflows. Now, of course, RBI, given an inflation targeting mandate, is going to look at inflation, but I'm sure this also plays at the back of their mind, that there is this worry about interest rate differential reversing. So I don't think we are going to see softer rates anytime soon. I think we'll see a lot of uncertainty on the inflation outlook, but the good thing is RBI has finally, after being behind the curve for a while, has finally started becoming watchful and very cautious about inflation, and is finally turning hawkish. I would actually be more convinced about the intent of the RBI now to achieve the target. But yeah, I don't think we are going to see softer rates anytime soon. And also, one last point I want to add is, I don't think we should expect the central bank to do the work of supporting growth when inflationary pressures continue to persist. Because in the short term, monetary policy is the only game in town to bring inflation down. And the more we expect central bank to stimulate growth, the more it distracts attention from more fundamental reforms that are required to boost growth. So therefore, we should let the central bank do what it's doing. Thank you.
Can I just make a short point, Mr. Thiagarajan? Sorry, just half a minute what Rajeswari said. You know, she said there's so much unprecedented situation right now. One more little data point is that the US inflation is something like 7 or 8%, and money supply growth is 0 or negative. This has never happened, you know. So
We are coming from a very strong growth, 3 years long. But just to pick a point, actually, whether Indian inflation can be tamed by monetary policy. Ajit, Dr. Ajit?
no, I don't think so. I mean, this is not me saying it. Everybody said. A lot of people say that India is different. Most of it is in food and fuel, and its supply. You know, they use. Many people use this some kind of mysterious word like, oh, this is supply. What is it called? Supply bottlenecks causing inflation, not demand. See, inflation is the rate of change of prices, and it doesn't matter if it's coming from demand or supply factors. It's basically, you know, you can explain that to an elementary school kid that if there's too much money chasing too few goods and services, that's called inflation. But whether monetary policy can curtail inflationary tendencies in India, no, I don't think so. By the way, I'd like to quote IG Patel, which is something I really like that quote. Mr. Ajit Patel, former governor of Reserve Bank of India, once said, he was actually quoting somebody else, E.M. Bernstein, who said that ultimately inflation is like a social tug of war. It's between the people who want let go of raising prices and people who want prices to be softened. It's a social tug of war. So there are people like Hindustan Lever, sorry to take a name, who will not stop at raising their shampoo prices because they say, oh, cost push, ke wo. And then there are people who just can't afford things, basic things. They want prices to be lower. So ultimately, the bigger contribution in this social tug of war is not just monetary prices, you know, policy cutting interest rates. That works in developed markets much better, but even, you know, transmission and all that. Really, it is about administrative measures. It's about trying to do other things to reduce the, if it's all about supply-demand imbalances, you have to figure out how to reduce those imbalances. So we do things like, they sound very draconian, so please don't get shocked, but we use things like stock, what is it called, stock limits. If people are hoarding food grains or hoarding stuff because they want to stock up and create scarcity and let prices go up, you got to intervene there. If supply is not growing, you need to say import. But now, if you're going to import stuff, you're going to actually create import inflation. So it's not going to be easy. It's going to take a combination of administrative measures, monetary measures, whereas fiscal measures also. You cannot, sorry, I'll take one more minute on this. You know, there was a lady, Prime Minister, her name was Liz Truss. She said, we are going to fight inflation by giving $500 to every household, or 500 pounds. You can't spend money and reduce inflation. She said that she said that we will. I mean, it's very kind of voodoo economics. But one of the strategy was we are going to put money into everybody's pocket so they can deal with inflation. You can't have fiscal expansion. You can't have and fight inflation. So the contribution from fiscal side has to be actually to curtail spending. We got to reprioritize spending because all spending is inflationary, especially fiscal spending. So it's not going to be easy, but I think we'll have to see a combination of all these three.
Can I take literally half a minute? So the way monetary policy comes in is, if, again, very simply put, as Ajit said, explaining to a small kid, if it's a supply-constrained environment where there are supply problems, and if you keep monetary policy loose, you'll be encouraging demand. So encouraging demand in a supply-constrained environment is a sure-shot recipe for inflation. So at least the one thing that monetary policy should not do is encourage demand when there are supply constraints.
Mr. Bhattacharya, actually, we will talk about the most interesting point. Whether the monetary policy divergence can be addressed by depleting FX reserve. That is spending out of FX reserve. We saw this, a 100 basis point rise in repo rate would have saved $100 billion.
So I'll approach this in a relatively indirect fashion. I'll not get into the point directly. One, following what all my fellow panelists and particularly Rahul mentioned, all global G10 central bankers, except the ECB, seem to be falling over themselves to try to signal that they are slowing down their rates, almost as if they are embarrassed by what they have done. Definitely all of them are going to slow down. So on that side, it's important. Second point is, in our quest to get to a 4% inflation, we should make sure that we don't also get to a 4% growth. Yeah, so that's very, very important. Yeah, too much of a good thing will certainly lead to problems, because remember, all of these effects are very non-linear. Although things look very cool, good, hunky-dory as of this point in time, there are these processes are very non-linear. You never know what tipping point is probably, it might come in. One point that we have not talked about so far, that's one part that is actually driving growth and demand, aggregate demand, is credit. Credit demand remains really remarkably strong, and particularly even for the MSME sector. That's what is really surprising, and there's very little sign of stress, even in those segments who, having been exposed to the series of shocks that we have seen over the last 4 or 5 years, still remain very, very resilient. And that demand is growing. At what point that credit demand begins to fall off is very important. That brings us to the third question that you asked in terms of the instruments that are available. So obviously all these instruments, whether it be the domestic rates, whether it be the exchange rate, whether it be whether it be liquidity management, all of these things are part of the whole monetary policy, fiscal policy, whatever, inflation control, price stability policies. One thing in the external environment that we still haven't talked about, it's not just the rates, which all central bankers are signaling that they are now going to slow down. It's the other part, which is the quantitative tightening and the effects of that, the non-linearity of that coming into play in the global economy and then spilling over into India. That's something that which is completely untested, because we haven't seen quantitative tightening for God knows how long. Nobody knows what effect that is likely to have. And remember, cutting down from an $8 trillion balance sheet to a $7 trillion, then to a $6 trillion is going to be very, very non-linear. So the final point in all of this, yes, exchange rates are going to be an important tool in this entire control issue of price stability. And these are connected. The whole macro is connected. You cannot let go of one and try to control the other. But exchange rates will probably act as an automatic stabilizer when domestic financial conditions are being tightened. So that's going to work. And RBI, to their credit, have done a very good job in terms of managing the exchange rate, because if you'll see, it's not just a matter of moving against the dollar. It's the dollar strength that has Mr. Thiagarajan, you have written the book on this. Our real effective exchange rates have been very stable. And on top of that, we have managed to keep the rupee, the USD INR rupee rate, in a very tight band if you compare it with a set of emerging market effects, EMFX, the more stable effects. So, all of this, so the exchange rate will definitely play a part, but you need to be careful, because as Rajeswari also mentioned, because there is that element of imported inflation, you need to have a tab. But most certainly, given the reserves that you asked, the first question that I have taken so much time to try to get to, the best measure that I've seen of how good, how effective the reserves are, is this measure, the IMF's measure called ARA, Assessment of Reserve Adequacy, ARA. Yeah, so that showed that we were very, very comfortable when we were at $650 billion worth of reserves, but that has now come down to about 2018, 2019 levels. So you cannot afford to fritter away the reserves trying to block a move in the currency which is due to exogenous factors. So obviously that currency management is very important. One final thing, it's no longer just a matter, given if this quantitative tightening that we are thinking is likely to have an effect. It's no longer a matter of just controlling exchange rate volatility, as the RBI publicly says. The governor in one of his speeches had mentioned that a secondary objective of the exchange rate management is managing expectations. Because when there is a dollar shortage, if there is a move, a significant move, the dollar shortage becomes exacerbated. And that's what needs to be managed. So that's a broad answer in what I say. So sorry about going on.
Yeah, thank you, Mr. Bhattacharya. Actually, Rahul, quickly, about the BOP deficit. Whether the large fiscal deficit is translating into large current account deficit, that's why we are going to have BOP deficit in the foreseeable future. In that case, actually, probably the exchange rate, the apprehensions of a sharp rupee depreciation over the next few years actually valid.
So I would say, the linkage between, say, the fiscal and the balance of payments effectively is a function of total savings in the system, right? I mean, it sort of gets connected to how much investment we are doing either on fiscal side or on the private side, and how does that sort of translate into the external balances. At this particular point in time, I would say, there is no real contradiction between what the fiscal policy is sort of doing in reality. I mean, the actual borrowings, both by the center and also by the states, has been a bit lower than what was indicated, and that's probably reducing the pressure. We have not necessarily seen bond yields spike up very dramatically in response to these pressures. Even on the current account side, I mean, so the way we look at it, I mean, Rajeswari mentioned that we'll have a number around 3.5%, this year. I mean, I think that's ballpark correct. But then the annualized rate, right, the run rate of the current account deficit, which was running closer to 5% at the middle of the year, is now probably around 3 and maybe going towards 2.5, right? So just at the margin, right, because FX markets are flow markets. I mean, they tend to be driven by flows rather than necessarily by stock of activity. And so in that particular situation, the pressure on FX is coming off. In fact, the rupee actually has been doing poorly, I mean, despite the fact global conditions have improved. And I don't think that's just a function of India's fundamentals being poor, right? I mean, the flow environment has actually been improving both on the current account and the capital account. And what we see is that the parallel build-up in the reserves on the RBI's books, I mean, partly because of valuation, but probably also because of intervention is increasing. I mean, the lesson I kind of take away from it is that RBI in the last 4 years has had this strategy of an asymmetric intervention bias, right, where they have been very aggressively buying dollars and then also not allowed the rupee to become expensive in real terms, as Saugata was saying, but then also have deployed that reserves very heavily when they felt that they had to protect the range. So this tight range environment is probably something that could also work on the other side if capital flows incrementally were to come back in a mean reverting fashion. So I think the focus on macro stability is something that comes across variety of policymakers, whether they are in Delhi or in Mumbai. That emphasis on maintaining stability in markets, in macros, and also in terms of sentiment is probably going to be the overarching objective of the way we manage our fiscal balances, the way we manage our current account balances, and the way we manage the financing, which is definitely probably the most challenging aspect, as Rajeswari said, looking out into 2023. I mean, that's probably going to be the one defining factor. The one good news, I think, or at least, the revealed behavior has been that both the rupee and the bond yields peaked out sometime, I think, in June, July. That was the rupee a bit later, bond yields, and so there's been a degree of, I guess, belief, or, like markets have been relatively stable in India compared to what we see elsewhere. And that probably sets us up for a relatively less turbulent 2023 compared to other countries, because bulk of the financing, at least on the fiscal side, is domestic in India, so should not create so much of negative spillovers looking into next year.
Thank you, Rahul. Actually, Dr. Rajeswari, one quick question. If there being no fiscal room and there is absolutely no monetary space, how the recovery could gain traction? Because exchange rate depreciation is one route.
Before answering that question, I just want to make one comment, which is what Saugata mentioned on the credit growth. So it is true that credit growth has picked up remarkably from about less than 6% during 2020 to 17, 18%. But we also have to be mindful about the composition of the credit. Because if I look at the last 6, 7 years, the share of industrial credit or business credit in total bank credit has fallen from about 46% to 28%. And the share of retail consumer credit has gone up from roughly around 18% to 30%. So today, retail consumer credit is a larger share of bank credit compared to business or industrial credit. And the reason that's worrisome is in absence of a developed bond market, there is no supply of credit for the industrial sector or the business sector. Of course, the other side of it is there is no demand for such credit because the recovery of the private investment cycle proves to be elusive. But while there is credit growth, we also have to be mindful about what sector the credit is going to. It's not really going to the business or the industrial sector. That was getting credit during the boom years of pre-2008. So on the exchange rate point, so yes, there is no room for the fiscal policy to be accommodative or stimulative to support growth. Monetary policy, as I mentioned, needs to stay focused on inflation. Therefore, the way I look at exchange rate is at the end of the day, exchange rate is a price. And when we have a current account deficit, that essentially means there is a mismatch of demand and supply of dollars. We are demanding more dollars than there is supply, and that's why there's a current account deficit. So in the short run, the only way to restore that external imbalance is by letting the price adjust, which is by letting the rupee depreciate. And the more we'll delay the process, the more the pressure will build up, the more tricky will RBI's job get, because trying to control any price in a relatively open economy is extremely challenging. The question is, how does the RBI do it? You start losing reserves, and then at some point you realize you've lost too much reserves, then you stop. It's a constant bet against the market, which is extremely risky. And RBI possibly cannot be using interest rate to defend the currency as well, since it has an inflation targeting mandate. So I don't particularly think that defending the rupee, managing the rupee is a strategy that the central bank should be following, considering we have decided to keep our capital account open. We need capital flows. And also, there are two advantages of letting the rupee depreciate. One is, of course, we should let it respond to the supply-demand forces. One is that as the rupee depreciates, the exports become more profitable and the imports become more expensive. So there is a natural adjustment mechanism for current account deficit in the medium term. And also, if you let the rupee depreciate, there is some price at which the Indian assets start becoming attractive to foreign investors. There is some price at which returns on government bonds in India start becoming attractive. So, and then that's a natural adjustment mechanism because that builds an expected appreciation. And as inflows start coming in, the rupee starts appreciating. But the more we try to delay that process of adjustment, the more distortions are going to keep building up. So I think the two most important things that we have to do in terms of boosting growth or even sustaining a 6% growth rate, whatever it may be, is to let the rupee depreciate and also to give a lot of focus on boosting exports. I think not enough is being talked about. Even in a slowing global economy, the share of India's exports in global exports is extremely small. Now, with China withdrawing largely from the international trade landscape, with Russia suffering from sanctions, there are two large Asian economies which have pretty much shrunk their share of international trade, creating a historic opportunity for India to fill up that gap. Exactly what countries like Vietnam and Philippines are doing. That is something that we should be focusing on. That is something we should be prioritizing in order to create growth and jobs, because the manufacturing sector is contracting. That's the pillar of job creation in India. So that is not going to pick up anytime soon. It hasn't happened in a very long time. Industrial credit is not picking up. So export is something that I think needs to be brought on the forefront of strategy and policy making. And we have to convey to the world that we are an export-friendly, export-oriented economy. And whatever it takes to do that. I mean, you let the rupee depreciate, let the exports become competitive, you stop being protectionist, you basically extend welcome to foreign producers who want to come in. FDI has been stagnant at 2% of GDP over the last 10 years. Not a particularly good news for a country who wants to be seen as a global powerhouse of the next decade. So I think in terms of boosting growth, exports should be something that we should be focusing on, and policy making should cater itself accordingly. And rupee depreciation is one small part of that package. Thank you.
Thank you.
Mr. Thiagarajan, I'm so sorry to interrupt, but we just have another 5 more minutes to conclude this session.
Yeah, absolutely. We also keep a track of what is that. Anyway, actually, Mr. Bhattacharya, 6% fiscal deficit, is it becoming a normal, new normal?
No, so very quickly, it's not. The finance minister in her speech was very clear about this. That I mean, the old FRBM glide path is gone. So that 3%, 3.5%. We are now looking to move to a 4.5%. So that's the step. 50 basis points reduction every year. So probably from the 6.4% this year down to a 5.9, then 5.4, etc. So I mean that 6% thing is not normal anymore for the center. States are a bigger problem. So states, that's a separate matter of conversation that I'll take up later.
We are not talking about the state. Dr. Ajit, quickly, fiscal prudence, whether it is the need of the hour.
This is a tough question for me to answer because I have got this lady sitting on the right who have given all this very gloomy picture about the fiscal situation. And I used to be, until recently, I'm now in academia, but I used to be a votary of fiscal support. Not an easy question. I think given that so many, as was discussed extensively, the drivers of growth, all of them have some issues, although we heard that perhaps exports through currency depreciation might have a chance. So I think even though fiscal consolidation has to be pursued over the next few years, in this particular year, 2023, I would not recommend a sharp consolidation.
Okay. The last statement actually basically key risk that you foresee for 2023. Rahul, you go first.
Sorry, the key risk for 2023?
Yeah.
I think the global risk is basically how do we live with very high interest rates that we have not seen in almost a full generation. I think the way we put it is that 2022 was the year of very sharp monetary tightening. 2023 will be the year where we have to live with it. For India in particular, I mean one particular issue that we are watching closely is basically how much can we do on the pandemic measures which were introduced. There is a need to think about sunset strategies around it, particularly given our food stocks are becoming more normal. So that's a risk, it's an unknown. We don't know how that plays out. But yeah, that's something we are watching closely.
Okay. Mr. Saugata, what is the key risk in one sentence?
Key risk in one sentence is the external environment. I mean, there's no doubt about that. That's the one to watch.
Dr. Rajeswari.
Financing a high level of current account deficit in an extremely volatile global environment, and not for next year, but I think the structural risk that we should all be very worried about is creating jobs. I'll just leave you with one number. Since 2015, the total number of workforce participation, the total number of people participating in the workforce has been stagnant at 400 million since 2015. There was a sharp drop to 300 million when the lockdown was announced, and it's gone back roughly to 400 million. So stagnant workforce participation from 2015. No matter what growth numbers we talk about, that to me is a serious sign of worry. Thank you.
Dr. Ajit.
Madam, that what you said, meeting the fiscal challenge and job creation, these are challenges, these are not risks. So please, I'm not being nitpicking, these are challenges to the economic policy maker. He was asking about risks. So I agree with Saugata, the main risks are geopolitical. So it can,
Thank you. The risk is the hostess might jump into the dais meeting. Okay, thank you very much. Actually, basically, you are out of time. Okay, it has been wonderful talking to all of you. And thanks, Almus, for making this occasion memorable. Thank you very much.
Thank you so much, Mr. Thiagarajan, for joining us. I'd like to invite on stage Mr. Biju to please give the memento to all our panelists. Mr. Jairam, could you please come up on stage? Ladies and gentlemen, a huge round of applause for all our wonderful panelists right here. A louder round of applause, ladies and gentlemen. Thank you so much, everyone.